Let's bring in at this point a research analyst with Meristem Securities, Ayodeji Olabisi, who joins me now to review the fixed income markets for yesterday and, of course, give us some outlook as to how the markets will close today, the final trading day for the week. Good morning, Ayodeji.
Good morning, Olaji.
It's good to have you on the program.
Thank you very much.
Give us a sense of how the market fared yesterday, where we're seeing some mixed trade. If you look at the bonds and the treasury bills markets, some kind of tepid trade for these markets.
Activities at the fixed income market has actually changed since the end of the MPC meeting, and we saw the 200 basis point increase in NPR. We've seen the market has reacted significantly to that, though we've actually seen some reaction even before the MPC meeting was actually concluded. That means that the market was actually sensing there was notes on the wall that there might probably be an increase in NPR, and markets started reacting to that. We saw repricing of assets. So far, we've seen that activities have changed. We've seen the T-bills have actually gone as high as about 18%, coming from about an average of 14% so far in July. In the last 2 days, we've seen it trading at an average of about 18.55%. And you're seeing the 12-month T-bills actually trading within the range of 23%, the 9 months about 19%. And this is actually strange comparing to what we've seen in the bonds market. In the bonds market also, you find out that the lower end of the yield curve has actually witnessed a lot of attraction. We've seen the 1 year bond actually trading as high as 19%. While you find out at the longer end of the yield curve, looking at the 5 to 10 to 20-year bonds, you're actually seeing those bonds trading within a range of about 15%. And that's simply whereby you expect there should be a higher yield at the long end of the yield curve compared to the shorter end of the yield curve. But that simply means that there is the investors are actually skeptical and people are just trying to play short to run for safety. That's why we think they're running to get to the shorter end of the yield curve.
Now, the treasury bills always provide some cover for those who are trying to avoid any very harsh conditions. So because of the short-dated instruments that are available for investors. But I would like us to take a look at the fact that the treasury bill space, according to reports that we got yesterday, remained awash with bearish sentiment. Now, despite the fact that it's more like a safe haven for investors, it's still bearish.
Yeah. Well, we've seen that the market, the T-bills is bearish at the moment. That is because investors are still trying to price in those assets. Investors still believe that the interest rate moving as high as 14% with what is happening. It simply shows the fact that the government really needs a lot of liquidity at the moment, a lot of debt. And with that going on, you think the investors are actually, they're the price makers at the moment. Let me call it that. They're the price makers at the moment. So they dictate the price. And they feel that the government is actually price taker at the moment. So they feel that they could still actually shift, they could actually still push yields northwards. And that is actually favorable for investors. So that is why we think that it's so bearish at the moment.
Are there particular instruments that investors are eyeing at this time that may actually lead to increased activities at the end of the market session?
At the moment, I think what you still find out is that the 12-month instruments are still most attractive for a lot of investors. Those are where you see the higher yields are coming from. I think having a return of about 23% on your investment for a 12-month instrument, I think is quite stable compared to what you can actually get in any other asset class, looking at the equities market and looking at the real estate segment. And when you also look at the money market space, I think 23% is still very, very attractive. And you see a lot of investors are still going to move towards the 12-month instrument. And you also need to bear in mind that there should be a T-bill auction which might be coming up next week.
Okay.
And where you see the central bank might be selling treasury bills about, 245 billion. And investors are definitely going to expect higher yields, a higher offer those treasury bill instruments also. So, and you need to understand that it is how the secondary market plays. That might actually be a lot of factors that might determine where the yields might actually fall during the treasury bill. That might be coming up for next week. So you might see investors still trying to push that.
All right. Thank you so much, Ayodeji Olabisi, research analyst with Meristem Securities.